The Iron Butterfly is a range trading option strategy and a variation of a similar option setup called the Iron Condor. Both these strategies use a combination of two credit spreads which face in opposite directions, calls on the upside and puts on the downside. The difference between the two strategies is the range of option strike prices used. The Iron Condor has 4 different strike prices and uses only out-of-the-money sold options for the body of the setup. The Iron Butterfly, on the other hand, focuses on using one at-the-money strike price at which both call and put options are sold, and this is known as the body of the butterfly, and 2 out-of-the-money bought call and put options, which are called the wings. As a consequence, the Iron Butterfly brings in a greater credit in comparison to the Iron Condor, and this is due to the higher priced at-the-money options that are being sold. But it also involves a greater risk. The risk is that the underlying stock price action will penetrate the wings before expiration date. This is because the wings will usually be closer to the current trading price of the underlying stock at the time when you enter the positions. Now let's compare the regular butterfly spread to the Iron Butterfly because they are different. We also need to distinguish between the concept of the Iron Butterfly strategy and another one that is simply called the butterfly spread. The butterfly spread consists entirely of either call or put options, but not both. If we were to break it down, we would notice that our butterfly spread is simply a credit spread and a debit spread that, as far as strike prices go, sit one on top of the other. When you enter a butterfly spread trade, you will usually see a net debit to your account. The Iron Butterfly, on the other hand, uses 2 credit spreads, known as a bear call and a bull put spread, respectively. These 2 credit spreads are what creates the iron part of this strategy. The idea is that you are bringing in a double premium and a net credit in the knowledge that whatever happens from here, only one of the credit spreads can lose if you let them run to expiration date. Let's look at a theoretical example to illustrate. A stock is currently trading at $40. Therefore, options with a $40 strike price will be at the money. We believe also that this stock will continue to trade within the range of $35 to $45 up to the time our option positions expire. We use the same number of option contracts for all positions and will assume that the options will expire next month. We're going to break our Iron Butterfly spread into 2 segments. Firstly, the bear call credit spread. Here we sell $40 at the money call options, and we also buy $45 out of the money call options. The second segment is called the bull put credit spread segment. And for this, we sell $40 at the money put options, and we also buy $35 out of the money put options. From the above, we can see that we have taken out 4 options positions simultaneously, with a common at the money $40 strike price for calls and puts to form our Iron Butterfly. But breaking it down, we have 2 credit spreads. So let's look at the characteristics of the Iron Butterfly. The first one is limited risk. Your risk is the difference between one of the strike prices on either side of the middle strike prices, that is the body of the Iron Butterfly, less the premium you have received from selling both at the money, call and put options. If option implied volatility is higher for the sold positions than it is for the bought ones, this will reduce your risk even further. The other feature of the Iron Butterfly is limited reward. Your profit is limited to the premium that you received from selling the at-the-money options. The other thing that we need to remember is the amount of collateral that will be required for this strategy. Normally, for credit spreads, you will need sufficient funds in your brokerage account to cover the difference between the strike prices multiplied by the number of shares that the option contracts cover. However, since it is only possible for one of your positions to be unprofitable at option expiration date, Most brokers will take this into consideration and only require a margin to cover one side of the spread. So here's a recommended strategy for the Iron Butterfly. First, you identify a stock that you believe will be range bound at least until the expiration date of your long Iron Butterfly position. Looking at monthly price charts can give you a clearer picture in this regard. Look for a stock or exchange traded fund that has a low historical volatility. Your broker should be able to provide this information for you, and therefore a high probability that it will continue its trading pattern. Second, you should examine the current option prices for the strike prices necessary to establish the strategy. Organise these into a table and evaluate the risk to reward ratio before placing the trade. The basic idea is to take advantage of option prices that will allow you to get into the trade for a maximum credit in comparison to the potential risk up to expiration date. For example, if you see an Iron Butterfly opportunity following a large price move in the underlying stock, then option prices for your at-the-money sold positions relative to your out-of-the-money bought ones can sometimes create a very impressive risk-to-reward ratio, even in the realm of greater than 1,000%. Exit strategies. You do not need to wait until option expiration date to exit your position. Providing the stock remains within the range you anticipate, this allows you some flexibility as the options approach expiration date. You simply evaluate the profit level within the final 2 weeks before expiration and exit when the market price of the underlying is closest to your at-the-money positions. However, if the price of the underlying should surge away in either direction and breach the outer strike prices, you can do one of two things. Either exit the profitable side of the position for a profit and also exit the unprofitable credit spread to ensure that you are not assigned the underlying shares, and the reason for this is because you have sold positions. Or, depending on where you think the stock may go from here, you could take advantage of a nice characteristic of credit spreads. Roll out the losing position to a later expiration month while letting the other side of the credit expire without risk.